Warner Brother, Netflix, and Paramount are locked in a bidding war worth over $100 billion. And history says that the company that wins will wish that it hadn't. I lived through this story personally, 35 years on Wall Street, and I watched otherwise brilliant people destroy value simply because they refused to walk away. Stay with me, because I'm going to show you exactly why the winner of this deal is likely to be the biggest loser and what that means for your money right now. Your money is tied to this deal, whether you know it or not. Warner Brothers, Discovery, Netflix, Paramount, three of the biggest names in entertainment. They're locked in a bidding war worth over $100 billion. And if you think this doesn't affect you, well, think again. If you like this type of content, please click like and consider subscribing. It's important to be in the know, and this is how you do it. Okay, here's what's happening right at this moment. Netflix has a signed deal to acquire Warner Brothers Discovery for roughly $83 billion. That's $27.75 a share. Paramount Skydance, run by David Ellison, launched a hostile counteroffer at $30 a share, all cash, a total enterprise value of $108 billion. This morning, February 17th, Warner Brothers Discovery rejected Paramount's $30 bid, but then, in the same breath, they opened a 7-day window and told Paramount to come back with their best and final offer. A senior Paramount representative already floated $31 a share. Wow, no surprise there. So this thing is obviously starting to escalate. And that right there is exactly where it gets really dangerous. Let me take you back about 25 years. I was driving my family to Disney World in Florida. Phone calls on the road, phone calls in the park. I literally ducked out of It's a Small World line to take a phone call. I ended up leaving my family on vacation and flying back to New York for a 1-hour meeting. We were pursuing the acquisition of a small optical networking company. Brilliant team, top-tier private equity behind us. The numbers actually worked out beautifully. We made an offer. The founder was going to become fabulously wealthy. And then, guess what? Crickets. And guess what happened? Another bidder came in and topped us. Our group quickly convened at legal counsel's office. We were determined to win this deal. And that is exactly the problem. When I threw out a higher offer price to my colleagues on the table, one of the most prominent investors in the room pulled me aside and asked me a simple question. Have you looked at the economics at that valuation recently? Well, that one question, it was very simple. It saved us from disaster. I went home, I ran the numbers, and the deal simply didn't work at the new price. And I called it off. It was actually painful. But that lesson, that single moment, has never left me. Here's the academic name for what almost happened to me. It's called hubris bidding. Richard Roll formalized it in 1986. He called it the hubris hypothesis of corporate takeovers. The idea is simple. Managers systematically overestimate their ability to create value. They overpay, not because they're stupid, but because they're human. In an auction with imperfect information, the winner is the bidder who most overestimates the value of an asset. Read that again. Okay? The winner is the one who overestimates the most. That's not a motivational poster. That is just math, stupid. And the empirical data backs it up. Moeller, Schlingmann, and Stultz studied thousands of acquisitions and found that acquiring firm shareholders, especially in large deals during merger waves, experience significant wealth destruction. Wealth destruction. The target captures the premium fast. The acquirer absorbs and regrets, slow and steady. We've seen this movie before, literally. AOL and Time Warner in 2000, Synergies were promised. They always are. What followed were massive write-downs and years of underperformance. Hewlett-Packard's acquisition of Autonomy in 2011, the premium was just too rich. The confidence was just too high. The impairment that followed was staggering. Quaker Oats buying Snapple in the 1990s, remember that? Well, that was a strategic fit, but it was a massive overpay. The rest, my friends, is really history. Every single time, the pattern is the same. The target celebrates, the acquirer justifies, and the shareholders of the winner cross their fingers. Now, Let's bring it back to today. Paramount is not just raising a bid. They are layering on financial voodoo. They're ticking fees, 25 cents per share for every quarter the deal doesn't close past December 26. That is $650 million per quarter. They're funding a $2.8 billion termination fee payable to Netflix if the deal falls through. And the financing? Let's talk about the financing. Part of it is backed by the sovereign wealth funds of Saudi Arabia, Qatar, and Abu Dhabi. Netflix has already flagged that as a national security concern. And the combined company, if Paramount wins, would carry a gross leverage ratio of nearly 7 times debt to EBITDA, with virtually no free cash flow before synergies. 7 times leverage on a deal born from a bidding war in a declining linear media environment? That, my friends, is really, really a recipe for very long hangover. And what about Netflix? They have the cleaner deal, signed, binding, backed by a $400 billion market cap and an investment-grade balance sheet. But if Netflix decides to respond by upping the ante just to protect its turf, well, guess what? They risk catching the same disease. The desire to win can overpower the discipline to walk away. That is exactly how good companies do questionable deals, and it happens quite often. Not because they're foolish, but because they're human. Here's the bottom line for you as an investor. This is not a question of whether media consolidation makes sense. It might. This is about price. In auctions, price is where the emotion usually hides. Every incremental dollar above intrinsic value transfers wealth from the acquired shareholders to the seller. That is not cynical. That is plain arithmetic. Warner Brothers shareholders enjoy the pop. The premium is real. But if you're holding stock in the eventual acquirer, watch the leverage, watch the synergy assumptions, and watch how quickly those beautiful pitch book numbers start to collide with reality. One macro hiccup, one integration stumble, one revenue miss, and the entire thesis simply cracks. I can still see that conference room today. I can still feel the temptation to add just a few more dollars to the offer just to secure the prize. The difference between a good deal and a bad one is often not the strategy, it is restraint. And in bidding wars, restraint is usually the first casualty. So your truth bomb for today is this. In a bidding war worth over $100 billion, the real loser is almost always the winner. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.